Happy New Year, everyone. And we are going to start this year off with an international fund. It's from Franklin and it's called the US Opportunities Equity Active Fund of Fund. So, right off the bat, there are two issues with any fund of funds in India. So, the first issue is the expense ratio itself. So, the fund that's giving you the exposure, basically the Franklin in this case, is charging an expense ratio of 0.63%. But also, since it's holding another fund, that fund also has an expense ratio. So there are like two layers of fees here, which needs to be looked into before investing in this fund, because we all think that it's just that 0.63% that you're gonna pay, but it's actually there are two layers of fees which is completely hidden when you are looking into fund of funds. Even I was completely surprised when I came to know that the expense ratio is actually much higher than 0.63%. That is the first issue. Second issue, since it's an international fund, you also have currency risk. That's something, again, is not directly visible, but something that needs to be looked into as well. So we will dive deeper into these two issues. And the main question to answer here is that, hey, is this product uh, good? No, is this product adding value to your clients and to end customers at the end, right? So let's start with a basic benchmarking analysis. So it's a US opportunities fund, right? So I think since it's a US fund, it's fair to compare this fund against S&P 500, which is the basic benchmark in the US, right? So as you can see, the when you compare this Franklin U.S. equity active fund of fund to S&P 500, over the last 13 years, it hasn't generated any value. As you can see in the recent years, especially in the last 4 5 years, the S&P 500 has clearly outperformed. And overall, from the inception, that is January 2nd, 2013, this fund has completely outperformed. The S&P 500, the benchmark has completely outperformed the fund. So to answer the question in simple terms, that this fund hasn't added any value as being an active fund and charging 0.63%. Again, we'll come back to the expense ratio, that the double layering of expense ratio, right? So it hasn't added any value to the end customer, because it is underperformed. It has underperformed the benchmark over the last 13 years. And we can also see the outperformance and underperformance on a yearly basis here, right? But on an overall cumulative basis, it has generated negative excess returns, right? To quantify this as a number, right? The excess return is basically, when you compare it to S&P 500, it's almost like 200%, um, uh, minus 200% in excess returns, right? Basically, it's underperformed by 200% since its inception, which is a lot of money that you're leaving behind, right? Like when you can easily invest in S&P 500, which is costing you about 0.1% compared to 0.63% for this fund. So I want to dive deeper into the fund it's holding, right? Because a fund of fund cannot give you much insight, because you're just holding another fund. So to analyze the fund in depth, you have to look into the fund that the fund of fund itself is holding, right? This is the exceptional thing about phenomenal gives to advisors and mutual fund distributors, is that you can analyze any fund of fund, but also you can analyze the fund it's holding itself, right? So in the fact sheet, you can see that the Franklin U.S. opportunity, this fund is holding a European fund, which is called like Franklin U.S. Opportunities Fund, and you can find this again in a platform, right? So since we are in the global region, right, you get access to 8 countries, right? This includes all 30,000 funds in the US, all 100,000 funds in the UK, Europe, Switzerland region. And on top of that, if you're also interested, or if you have clients, let's say in Australia, Canada, or or obviously in India, right? So you get access to eight different markets and eight different mutual, like you eight different countries mutual funds and ETFs and stocks, right? So it's a Luxembourg fund that this Franklin is holding, right? And you can see that it's managing as north of $1 billion in assets, about $1 billion in assets, and this fund is being compared against S&P 500. So we already saw that it doesn't outperform. The same story follows here, right? The S&P 500 has outperformed the fund, that which is the Franklin U.S. Opportunities Fund. So the reason I want to look into this is that I can go in depth into what this fund is constructed of, right? So what are the top 10 stocks? So there's no doubt, right? So it's like Nvidia, Microsoft, Apple, all the big tech companies, right? And since it's primarily focusing on the US market, right, you can also see the breakdown by top 10 countries, and not so surprisingly, 90% of this fund is focused in the US region. It's very easy, if you have seen S&P 500, right? Because majority of your exposure goes to the technology sector. So not so surprising again here. So the Franklin U.S. Opportunities Fund has a high exposure of about 70% in the information technology sector, compared to about 50% in the S&P 500 index. Now that we have looked into the fund of fund, but also I've shown you a way to analyze the fund that this fund of fund is holding, it now brings us back to those two main questions that we discussed at the start. First is the expense ratio. So to debunk this expense ratio, I'm going to compare these two funds, which is the fund it's holding and also the fund of fund, right? So this is the Indian fund, right, that we can all buy. And second one here is the European, the Luxembourg fund, that technically you cannot buy it, right? But this is just for us to see how big a different the return is because of the double layering of the expense ratio. So you can see that the Franklin U.S. Opportunities has clearly outperformed. Both these funds are the same, right? These are exactly the same, because this fund, the yellow color fund, is actually holding the blue color fund. But why is the return a big difference? It's again, it's the expense ratio, right? Because the blue color fund, that is the main fund, is charging you about 0.85%, right? And this Indian fund that's giving exposure to this European fund is charging 0.63%. So you're actually paying about 1.5% expense ratio for the direct question. This is not even a regular version, right? So for a direct question, you're paying an expense ratio of one point on north of 1% for an international fund, right? That is just a humongous and a rip off, right? In a sense that when you can buy S&P 500 for point one, like 0.1% or 0.09%, right? This is like a complete rip off, if you ask me, because you're paying north of what 1.4%, which is a lot, right? So let's currently like just compare these two funds against S&P 500 and see just the comparison, right? Especially in fees, right? So you can see that in fees it's just very low. It's like almost close to 0.1%, right? Whereas here for this fund, although it's showing 0.63%, you're paying 0.63% plus 0.85%, which is humongous. So, and that's why you're seeing a massive difference in the Indian fund, right? That which is that it underperformed the European version, um, even though they are holding, even though it's holding the same fund, right? And the return difference that you can see here is the total return, right? So 705% compared to 784%, right? So almost 80% you're leaving on the table, right? Just by paying an extra 0.63%, right? This is something to be aware of, especially investing in a fund of fund, because you are not the fees are not visible. The fees need to be more transparent than what it's being shown here, but it's something to be very you should be more diligent about when you're looking into the fund of funds, right? And even in their website they clearly state this actually. So if you go here, they say the fund of fund disclaimer here, right? The expenses of the fund of funds scheme will be over and above the expenses charged by the underlying fund, right? And they also tell you the reason here is investments in overseas financial assets are subject to risks associated with currency movements, restrictions, transactions, procedures in overseas market, and country related risks. So you have two issues. Again, going back to the issues that we discussed, right? One is the expense ratio. Second one is the currency movements, right? Since it's a US, you're getting exposure to the US market. You have the US dollar INR exposure, right? And this is like such a beautiful thing about phenomenal again, is that you also can analyze the currency exposure, how much has currency impacted your returns, right? Since INR has been depreciating for decades now, compared to US dollar, right? So you can see that pre-FX, post-FX, right? So pre-FX is basically the fund itself, right, without adjusting it for the Indian currency, INR currency. So once you adjust it for INR, you can see a massive improvement in returns, right? So you can see the return of the fund itself is 433%. When you compare that to the post FX, which is after adjusting for INR, that is how much ever the INR is appreciated, it's massive, right? It's almost double the returns that you're getting just purely with the currency exposure, right? And to evaluate this exposure, you can look into the last 10 years of on each year how much the currency has impacted your returns, right? So for example, in 2018, just with the currency movement, you got about 9% in returns just with the INR, right? INR depreciating against the US dollar, since you are buying the US dollar, right? So you're getting about like 9% in returns, right? Whereas let's say in 2023, you got about 0.8%. So to compare on an overall basis, right? Just with currency impact on this portfolio level, is you're getting about 350% in just returns, right? That is the currency returns, not the underlying fund returns itself, right? So underlying fund returns is 433%. The currency return on top of that, because you're buying it using INR, it's 350%, right? And finally, it's the exchange rate that we all know that US and INR, it's been going up for decades now. So in this video, we discussed about this international fund of fund, and we discussed two main issues. One is the double expense ratio, right? Where the fund of fund charges an expense ratio, and also the fund it's holding also charges another expense ratio. And we saw how much fees are important to the overall end result for the customer, right? So we saw that the main fund is actually outperformed the fund of fund because it's charging an additional 0.63%. And second one is how currency can impact your returns, right? So just with currency movements, you got about 350%, just over like what 10 to 13 years. I think that brings us to the end of the video. Thanks a lot for watching and have a great year, and I'll see you with another interesting fun. Thanks a lot.